Hi, my name is Erin Higgins, and I am the Operations Manager at OHFA. And this webinar is going to cover some of the basics of our program as well as our products. This webinar is being recorded on Friday, July 19th, 2019. So if you are watching it on our website, please make sure that you are checking our guidelines to see if any changes have been made since. Any changes that I know of that are coming, I will let you know throughout this webinar. Okay, so let's get started. OHFA's mission is to open the doors to an affordable place to call home. We hope we do this by offering competitive rates, down payment assistance, and excellent customer service. The customer service is a very important piece to us. So if you feel like you're not getting good customer service, please make sure that you contact me. The basics, all of our loans except for our 203Ks are currently serviced by U.S. Bank Home Mortgage. We do offer the 203K standard and limited through our Renovate Ohio program, and those loans are serviced by First Home Mortgage. All loans can be reserved in our system, which locks the loan by participating lenders from 9:45 in the morning to 8 p.m. at night, Eastern Standard Time, Monday through Friday. So we get a lot of emails at between 9 and 9:45 saying the programs are not there, something's wrong with their website, but until 9:45 they will not be available. Once a loan is reserved, any product changes have to be approved by OHFA. So please, if you reserve a loan and your borrower decides that they want to change, maybe they don't want down payment assistance, maybe they want more down payment assistance, please don't cancel that reservation. Please just contact us, and there'll be contact information at the end of the webinar, who you can get in touch with to make those changes. But please don't cancel the reservation. You will not be able to reserve for the borrower again, so we would have to make any new reservations, and we're probably just going to use the same one. We do ask for a commitment package to be submitted to us within 25 days of reservation. So there's a small amount of documents, typically 2 pay stubs in the last 60 days or 1 pay stub and a written VOE, 3 years tax returns, a 1003, a transmittal, and a purchase contract. There may be additional things that we want if you're doing our Grants for Grads program or our Ohio Heroes program. But typically, those are the documents that we're looking for. So we're hoping that you have those within 25 days of reservation. Also, if we don't have them, typically long around day 18, we will send an email. We usually start with the loan officer. If we don't have the loan officer's contact information, we'll go to the processor, and as a last resort, we will go to the person who reserved the loan. Sometimes, depending on who the lender allows to reserve the loans, those are done, in a secondary marketing or lock desk, so they don't necessarily know the status of the loan. But basically, we will reach out to you before we cancel the reservation. But if we don't hear anything from anybody, then we will cancel it at a certain point. So please make sure if you hear from us that you're letting us know what's going on and when we will receive the package. But as I said, most of the documentation that we want, hopefully you're going to have by day 25. Loans must be purchased by the master servicer within 70 days of reservation in order to avoid any extension fees. So just something to keep in mind. 70 days is when they need to be purchased, not when the loan needs to be closed. It needs to be closed and purchased within that 70 days. So definition of a first-time home buyer. Prior to coming to OHFA, I was in the mortgage origination business for 30 years. Did a lot of OHFA loans in that amount of time, but I didn't know what the definition of a first-time home buyer was until I got to OHFA. So I thought this would probably be a really good thing to let everyone know. So the definition of a first-time home buyer, according to the IRS, and we go by the IRS guidelines because we do a lot of tax-exempt bonds, or we do our MTC program, and those go by IRS guidelines. So the IRS says that first-time home buyer is a person who has not had ownership interest in their primary residence in the last 3 years, which seems pretty simple, but we get a lot of people caught up in ownership interest because of dower rights in the state of Ohio. So if you have someone buying a property and they have a non-purchasing spouse, we are also going to ask for documentation on that spouse to make sure that the non-purchasing spouse does not own the home that our borrower has lived in any time in the last 3 years. Because according to dower in Ohio, as soon as you get married, if your spouse owns property, you have dower interest in that property. So we will be asking for documentation on the non-purchasing spouse to prove that they don't own the home or the homes that the purchasing borrower has lived in the last 3 years. If they do, then the borrower does not meet that definition of a first-time home buyer. And in order to be considered a first-time home buyer, if that's the case, then they have to be buying in a target area, because anyone buying in a target area, it can automatically be considered a first-time home buyer. That one kind of trumps all. And there is an exception for qualified military veterans who have earned an honorable discharge, are eligible even if they have had ownership in their primary residence in the last 3 years and they are buying in a non-target area. They have a once-in-a-lifetime exemption to not meet those other two definitions and still be considered a first-time home buyer. So just some things to keep in mind, because a lot of times that the dower rights, the dower ownership messes people up. So just a note, since we do allow, since they could own other property, so you could own rental property and not live it, and not own your primary residence, or if the borrower is buying in a target area or using our Next Home program, they could own other property or retain their current primary residence after they close, in which case we would use rental income towards their maximum income limit. Keeping in mind that we are not qualifying this borrower. The income that we calculate is almost always going to be different than the income that you as the lender calculate and that you as the lender use to qualify that borrower. For instance, you might not need to or be able to use overtime or bonus or child support or pension or whatever else, but we're going to count it because that is income that the borrower has coming in, and that we need to use to determine towards our max income calculation to determine whether they meet our income guidelines or not. So just keep that in mind, that we're not talking about qualifying income like you are. We're talking about what we call eligibility income. Okay, so how are you notified of new rates? Every lender that signs up with us tells us who they want their main contact to be, and we send out an email blast every day with our rates to those main contacts, and hopefully they pass them on, but they are also available on Lender Online, and they are available on our website every day. Midday rate changes are possible because some of our loans are sold in the secondary market. If there are any midday rate changes, we try to give you at least an hour's notice that we're going to be changing rates so that you can get them locked in, but just understand that it is possible. Here is a sample of what our rate sheet looks like currently. You'll notice that we have traditional first-time home buyer, government and conventional loans. We have our Next Home loans. We have MTC Plus. And we have a Renovate Ohio. So there's differences between the first-time home buyer, Next Home and MTC Plus, and there's also, it's also different if you're doing a Renovate Ohio. And just to give you kind of a close look of it, our traditional first-time home buyer rates, you see that we offer without down payment assistance, with 2.5% assistance and 5% assistance, and with each time, and the more money that the borrower borrows, the higher the rate's going to be. So again, we talked about, I already mentioned that we would like the loans within 25 days of reservation. There is nothing that needs to be signed by the borrower prior to submission to us. That used to be the way things worked, but we made that change a few years ago where we don't require that anything be signed by the borrower. We will prepare a commitment package to be signed once we approve the loan, and we'll make that available on Lender Online. So keeping in mind that you have 70 days to get this loan purchased by the master servicer, you want to make sure that you are reserving it in the correct amount of time. So it's not that we don't want it if it's going to take a little bit longer. And things like foreclosures, new construction, short sales, things like that are going to take a little bit longer to get to closing. So you want to make sure that you are not reserving the funds too early, because then you will be charged extension fees. And we don't allow those extension fees to be charged to the buyer or the seller without our prior approval. So even if you're going to be charged them, you need to get our okay to charge them to the buyer and the seller. And if, we saw that you reserve something like a new construction, for instance, or a foreclosure that was going to take a lot longer to close, and you know that, or should know that, then we would not allow that to be charged to the borrower. And these are low to moderate income borrowers who need this money to close, so we don't want, more fees being charged to them. Okay, so new reservation limitations for the same borrower. We do not allow the same borrower to be reserved for the same property unless it has been 60 days beyond the original 70-day reservation. Basically, we don't want you canceling or re-reserving the borrower thinking that you're going to get a lower rate. This also applies if the borrower decides to change lenders. The borrower is not going to be able to cancel his loan with you in order to get a lower rate with another lender and come through our program. We're going to know that they've been here before, and if they're buying the same property, then they are going to get worst case pricing, basically. Okay, so if you need more time, you do not have to request it. Although if you want to make sure that your lock is still good, we can always extend that reservation for you. That is no problem. But U.S. Bank or AmeriFirst, when they purchase that loan from you, they will automatically net out any extension fees that are due to us. But we will, we have no problem if you need us to extend that rate for you, or you need us to extend that commitment approval date. That's no problem. So TRID, everybody's favorite subject is TRID. So I just kind of want to go into a little bit of detail about how we handle TRID, and a little bit of the history of that, because people want to do what they want to do, and not necessarily what we require. So back when TRID came into being, for lack of a better word, we had to figure out what we needed to do with our seconds. We have a second mortgage that doesn't have any payment, that's forgiven after a certain amount of time. So prior to TRID, we weren't really doing anything. Maybe we should have been, and maybe lenders should have been, but nobody was really doing anything. So when TRID came about, we had to take a look at it and see, all right, what are we responsible for? What needs to happen here? So at the time, there was you could do a partial exemption, which means that you could use TRID docs. But in order to do so, you had to meet these 6 or 7 criteria. One of the criteria said that your fees associated with closing the loan could not exceed 1% of the loan amount. Well, the only fee really associated with the second mortgage is the recording fee. But since you have since the loan amounts are so low, 2.5% or 5%, oftentimes the recording fee was going to exceed 1% of the loan amount. So we were not eligible probably 99% of the time for the partial exemption. So then we had to look back and see, all right, are our loans subject to TILA? Well, there's no payment, there's no, none of that, nothing about the loan would be subject to TILA. So we had to look at RESPA. And it was subject to RESPA, and RESPA requires that you have a GFE and a HUD-1 settlement statement, not an LE and a CD. Giving the borrower an LE and a CD does not meet, it meets TRID guidelines, but it does not meet RESPA guidelines. So we were fortunate enough during this whole period of everyone setting up for TRID to have a couple of conversations directly with CFPB. And we said, okay, we're going to have a GFE and a HUD. And they agreed. GFE and a HUD was the way that we needed to go. But lenders aren't going to have access to a GFE once TRID goes into place. So how about if we provide a GFE to the borrower within 3 business days of the loan being reserved with us, which likely will not be, in many instances it may not be within 3 business days of the lender taking the loan application with the borrower. However, the second mortgage closes in OHFA's name. The second mortgage is for Ohio Housing. So we are the lender on the second. This would be our application date, is the date that the loan is reserved with us. So how about if we provide a GFE within 3 business days of the reservation? And they agreed that since we are the lender on the loan, that we can do that. So within 3 business days of reservation, we will send a GFE to your borrower that's simply going to have their name on it, the property address, and it's going to show a recording fee of $52. And how we arrived at $52 is it's $28 to record the first 2 pages of anything in the state of Ohio and $8 a page thereafter. So we thought, okay, maybe we have a long legal. Let's just try to account for that. $8 a page after, that's where we got $52. So we will send the GFE out within 3 business days. We will upload it to our website on Lender Online on our eDocs page, so that you have access to it, because U.S. Bank is going to want it from you. And we will not redisclose that. If the loan amount changes at some point, it's not going to change the recording fee. It doesn't matter if the loan is for $1 or $6 million. The recording fee is the same. There is no payment, so there is no reason to redisclose. There's no change of circumstance that will require us to redisclose if the loan amount changes on the second, which is probably going to happen. So when you ask us for it, we're going to tell you you're not getting one, and that's why. And then you as the lender are required to provide a HUD-1 settlement statement, the most recent one that shows the difference, shows the breakdown between GFE and HUD and all that, and the HUD-1 and all that good stuff. And the only thing it can show on it is the recording fee. If there are any other fees that are listed on that HUD-1, and you are required to do a HUD-1, you are required to put the recording fees on the HUD-1 for the second mortgage. If there are any other fees on there, we're going to make you refund those to the borrower, because once you start putting other fees in, you could possibly get into TILA, and we really don't want to go there. Because I don't have the ability to do one, you don't have the ability to do a sale most likely, and we're just not going there. Okay, so an update in July of 2018, I believe it was, 18, CFPB made a change based on a lot of input from the housing finance agencies to say that, that recording fee of 1% really makes us not eligible for the partial exemption. So they removed that 1% recording fee they removed the recording fee from the 1% that you had to take into consideration for fees. So we thought, great, our lenders are going to be very happy that they can now do an LE and a CD for the second. So we made that announcement and got a lot of feedback from our lenders, especially our top lenders, who said they did not want us to require them to use TRID docs. A lot of their systems weren't set up to be able to provide an LE for a loan that has no interest rate and no payment. and they just felt like it would be way more of a burden for them to do that than it would be for them to do a HUD-1. So we had the option to still require a GFE and a HUD-1. So we revoked our requirement that you do an LE and a CD, and we are continuing to do a GFE and a HUD-1 at the request of our lenders. So hopefully that explains TRID. I know it's a little dry, but kind of needs to be said. Okay, so let's get into our programs and what we have to offer. So we offer down payment assistance in the form of a forgivable second mortgage. We have our regular down payment assistance second mortgage, and then we have a second mortgage for our Grants for Grads program. And there's a lot of similarities, but there are some differences. So if you're not doing a Grants for Grads loan, the borrower is eligible for what we call your choice DPA. And it's your choice because you can decide between you and the borrower, you the lender and the borrower, you can determine whether they need 2.5% or 5%. The money can be used towards down payment, closing costs, or prepaid. Up to you what you use it for. These liens are forgiven and released after 7 years. If the home is sold or the first mortgage is refinanced prior to the end of the 7th year, the loan must be repaid in its entirety. We get a lot of questions. A lot of people forget. Borrowers forget. Lenders forget. If you're not doing our Grants for Grads program, since September 1st of 2015 is when we made changes to our program to require that the borrower has to keep the home and the first mortgage for at least 7 years. If they don't, that's fine, but they have to pay the lien back in its entirety. So our other second mortgage is a Grants for Grads, which really works. It's the same in the sense that it's 2.5% or 5% of the purchase price. We do not offer Grants for Grads without down payment assistance like we do the others. And the Grants for Grads program, just for a little bit of history, came to OHFA from our legislators. They really wanted a program, something to help attract college graduates to Ohio and to keep them here. And so they came up with this idea and they gave it to OHFA and said, here, figure it out. You guys administer this. So there are things that we can change about the program to make it better, but there are some of the things we just can't change at all. So these are for borrowers who have graduated from an accredited college within 48 months of the reservation date with at least an associate's degree or higher. So we would require evidence for the Grants for Grads of when the borrower graduated and what their degree was. The rates for the Grants for Grads program are lower than our traditional first-time homebuyer rate. That's one of the things that had to happen, was the rate had to be a little bit lower. And the big difference is that makes this loan, in my opinion, the best one that we offer is that the second mortgage is forgivable at 20% a year over 5 years. If the borrower sells the home and can provide us with evidence, and sells the home prior to the end of 5 years and can provide us evidence that they are going to continue to reside in Ohio, the remaining balance of that second will be forgiven. If they move outside of Ohio, then the balance will be prorated based on when they sell. So if they've already passed for instance, they passed their 3rd anniversary, and they sell their home, they would owe 40% of the balance, of the original balance back. And if these borrowers refinance their first mortgage, we will resubordinate the second. So because of the repayment terms, personally, I think the Grants for Grads is the best loan that we offer. So something to keep in mind. Okay, Ohio Heroes. We also offer a program for heroes who are active military veterans, firefighters, EMTs, paramedics, healthcare workers, which are really doctors and nurses, police officers and teachers. And these are the lowest rates that we offer. Our Ohio Heroes program are the lowest rates that we have. We do have our program guidelines are very specific for each occupation. You can see what kind of documentation we need for each occupation. You may have somebody who could use the Heroes program or could use the Grants for Grads. For example, maybe you have a nurse who's graduated in the last 4 years from nursing school and could be either a hero or you could use Grants for Grads. Again, the hero is going to be the lowest rate, but it has that 7-year provision. So they're not going to be able to, if they would refinance or sell their home in the first 7 years, they're going to pay the down payment back in its entirety. Whereas if you go with the Grants for Grads program, you've got the 20% a year over 5 years proration, and the possibility that if they sell their home, the remaining balance can be forgiven, or they would pay back only the prorated part, and we would subordinate the Grants for Grads. So just something to keep in mind. Okay, we also offer Fannie's HFA Preferred Program and Freddie's HFA Advantage. We get a lot of questions asking if we do Home Ready and Home Possible. What we offer is Fannie's version of Home Ready, which is called HFA Preferred, and Freddie's version of Home Possible, which is called HFA Advantage. So it's kind of Home Ready and Home Possible are kind of the basis, but there are a lot of variances that make these programs better than those programs. So you can do up to 97% LTV with an approval through DU or LP. There are no loan level price adjustments, so it doesn't matter what their LTV is, and it doesn't matter what their credit score is, doesn't matter what the property is, there's no loan level price adjustments. Mortgage insurance is offered at charter minimum rates. So the coverage requirements are listed on our program guidelines. However, if you're doing, for instance, a 97% loan to value, you have 18% coverage is required. At 95%, it goes down to 16% and so on. But the MI is cheaper. You can combine it with our down payment assistance. So you could have a CLTV up to 102%. Single unit properties, you can, if you're doing a 1 unit, you can go to 97. Fannie does offer 2 to 4 units at 95%. And there are some differences between what Fannie allows and what Freddie allows. Just a couple off the top of my head. Like I said, Fannie does a 2 to 4 unit. Freddie does 1, and that's it. They won't go 2 to 4. Fannie allows non-occupying co-borrowers, whereas Freddie does not. So there are some little differences that are all spelled out in our guidelines. These are great programs. The more we have talked about them, the more volume we have gotten. We used to have, our volume used to be about 10% FHA and 10% conventional and 90% FHA or government. And now we are about 60% conventional and 40% government. So, a conventional loan just overall typically is better for the borrower if they can get into a conventional loan. We'll see some more, we'll talk later about the DTI and the credit scores, and those are more favorable on a conventional loan too than on a government loan. However, Fannie has announced that as of September 5th of 2019, some changes to our program. I'm sure you've all already heard about the changes that are coming to Home Ready and Home Possible. And those do affect this program. So effective September 5th, as of this date anyway, September 5th, unless we can get them to extend that out to give us a little more time to adjust. But as I'm speaking to you today on July 19th, as of September 5th, we will be announcing that we are going to limit Fannie Mae production to borrowers whose qualifying income is at 80% AMI or lower. Fannie is making that once has made the changes so that once the qualifying income goes over 80% of the area median income, that we lose all of the variances that we have in HFA preferred, which is the rates, the no loan level price adjustments, the charter minimum rates on the MI. So that all of those variances go away, the 2 to 4 unit at 95%, all of those variances that make our program advantageous go away. So we really believe that based on what Fannie has given us for loan level price adjustments or G fees or whatever we would choose to do are going to make the program so non-beneficial that we're not going to, people are not going to use it. Or in addition, it's a lot of there's a lot for us to do and for U.S. Bank, our master servicer, to do. So we've just made the decision that we're not going to allow over 80% if the borrower has qualifying income is over 80% of the area median income, we're not going to do it in our program. We may allow on a case-by-case basis if it's something that you really need, but we pretty much figure it's not going to be favorable for you to do that. So that's a change that is coming. Freddie Mac has not yet announced what they're doing. We know that they are making changes, and they're discussing what those changes are going to be. We've had conversations with them, so we know what they're thinking, but we don't know what they're actually going to end up with, and that's probably going to happen, we're thinking, first quarter of 2020. So stay tuned for that. But you should see an announcement from us soon regarding, how we're going to handle Fannie, and those changes will be on our program guidelines also. Still a great program for those who are within the 80%, who are at or below 80% of the AMI. So something to consider. Okay, OHFA Advantage is for those who are in the low to very low AMI space, qualifying income. These are for conventional loans only. This is a grant that we offer for conventional loans only. It is a grant that is provided by Freddie Mac, so loans must be run through LP. You're going to use the same conventional pricing as we show on the rate sheets. There's no additional for this. But borrowers whose income is at or below 50% of the AMI for the county can receive an additional $2,500 in grant funds. And if they are between 50 and 80, they can receive an additional $1,500 in grant funds. So how this program works currently is it's based on the lender's qualifying income, not on the income that OHFA determines that the borrower, their eligibility income. And again, eligibility income is the income that we calculate for the borrower to make sure that they do not exceed our maximum income guidelines. So we're still going to do that calculation, but we're also going to look at the qualifying income that you as the lender use. So, I get questions about, do you count, since we don't count non-occupying co-borrower income towards our max, but you're still going to use it to qualify the borrower, it's qualifying income. So even though we might not use it towards the max, you're still Freddie, it's the Freddie program, is going to look at the income that you as the lender use to qualify this borrower. So Freddie's offering this. We do expect that once Freddie makes their changes, that this is going to change also. Not sure that it will completely go away, but we think that they're going to make some changes to it. So just remember that if you use this, you have to run the loan through LP and you have to get an accept from LP. Okay. So moving on, we also have our Next Home Loan Program. So borrowers who are not first-time home buyers, they don't meet any of those definitions of the first-time home buyer that we discussed earlier. they can still get our Next Home program. The same guidelines, income, purchase price limits as a first-time home buyer. All programs are available for Next Home, with the exception of the grants for grads and our MTC Plus, which we're going to talk about in a minute, because those are strictly for first-time home buyers. Also, on the Next Home and MTC Plus, we'll talk about in a minute, we now offer Next Home without down payment assistance, which we were not doing until this year, the beginning of 2019. And we also only offer it with 2.5% down payment assistance. We no longer offer it with 5%. It's not available with 5% DPA. And the rates could be higher than the first-time home buyer rates. And the reason for that is the Next Home loans and the MTC Plus loans cannot go into a tax-exempt bond. So our first-time home buyer rates are going into a tax-exempt bond, and those rates kind of get set and don't really move unless we need to do a new bond issue that we can't fit into those, that would cause those rates to possibly change. But the Next Home and the MTC Plus cannot go into a tax-exempt bond, so they have to be sold in the secondary market. So we really were trying for a long time to have one set of rates for everything, and the loans that get sold in the secondary market can't be priced like the bonds can. So we were losing a lot of money. And while we're not trying to make money, we're trying not to lose. We don't really want to lose a lot of it. So that's why the rates are now different. And the reason that we only offer the 2.5% DPA versus the 5% is because in order to make the 5% a rate that would be favorable to the borrower, OHFA loses a lot of money doing that. And again, we're not trying to make money, but we're not trying to lose a lot of it either. We would like our program to be sustainable for a while. So that's why we don't offer the 5% any longer. Okay, so MTC Plus, pretty much, well, not every lender offers it, but every lender could offer it if you wanted to. So our MCC or MCC, you've probably heard it as MCC, which is a Mortgage Credit Certificate, but we changed the name just internally to call it a mortgage, or MTC, a Mortgage Tax Credit, because we think a borrower understands mortgage tax credit more than they understand what a Mortgage Credit Certificate program is. And there's been a lot of, over the years, misunderstanding about how it works. I know personally, when I was a lender, no clue how this worked. It seemed so complicated that I just really didn't use it. But it is not complicated. It is very simple. So hopefully over these next couple of slides you will understand that. And it is a great benefit for a first-time home buyer. So we have, somebody who has to meet the definition of a first-time home buyer. The income limits are a little bit lower for MTC than they are if you're not getting MTC. You can layer it with, the plus part is that you can use our first mortgage, our second mortgage, and you can layer it with the MCC. Again, we're only offering 2.5% down payment assistance, not 5%. And we still offer, if you wanted to do what we call MTC Basic. So if you didn't want to use our first mortgage and you didn't want to use our down payment assistance, you wanted to do your own first mortgage, and the borrower is a first-time home buyer and meets the income guidelines, then you can do that. The credit amount that the borrower is going to get is going to be different if you use MTC Plus. If the property is in a non-target area, they're going to get a 20% credit. If it's in a target area, the credit will be 25%. Or if it's an REO, the credit will be 30%. If you do the MTC Plus, though, which is our first mortgage and maybe our second, the borrower is going to get up to a 40% credit. And those credits will make sense in a second here, how those work. But all of them, the 25, the 30, and the 40% credits, the IRS limits the dollar amount that the borrower can use every year to $2,000. For whatever reason, they don't limit the 20%. So if they're at 20% credit, they could get more than $2,000. So sometimes if it's a higher loan amount, the borrower might be better off as far as the credit goes doing the MTC Basic versus the MTC Plus. You just kind of have to do that math. So to show you, to illustrate how that works, here's a sample tax return that our friends at Colorado Housing, got to give them props, our friends at Colorado Housing did, and we just borrowed. Obviously it's from 2013, but it still works the same way. So on the left on page 1, you will see that in blue you have a borrower who's doing $50,000, and the blue represents the borrower who has the tax credit, whereas on the right, the black represents the borrower who does not have the tax credit. They both earn $50,000. And if you come over to page 2 where you have itemized deductions, you will notice that the borrower with the tax credit has itemized deductions of $9,772 versus the borrower without the tax credit has itemized deductions of $11,361. And I know what you're thinking is that in 2018, probably a lot of people are going to take the standard deduction and not itemize, which is fine. They do not have to, borrower does not have to itemize to take this credit, but prior to 2018, probably most homeowners did. So let's take a look at their itemized deductions so you can see where the difference comes in. So the credit is based on the amount of mortgage interest that the borrower pays every year. So in this instance, if you look at the itemized deductions on line 10, this borrower paid $7,946 in mortgage interest in 2013. In this example, they have the 20% credit rate. So again, 20% in our program means this borrower did an MTC Basic, which means they used their lender's first mortgage and they bought in a non-target area. So they have the 20% credit. Had they purchased in a target area using the MTC Basic, they would have had, the credit would be 25%. If they had bought an REO and done the MTC Basic, it would be 30%. And if they'd used our program and done the MTC Plus, it would have been 40%. So that's where the tax credit amount comes in. So this is a 20% credit, which is $1,589. So 20% of $7,946 is $1,589. So now you go back over to the mortgage interest paid on the itemized deductions and subtract that $1,589 from the mortgage interest to come up with $6,357, which then follows down to the $9,772 versus the $11,361. Okay, so we're going to turn back to page 2. And you follow this down to, now you take out the exemptions and the taxable income, and we figure out that this borrower has a tax liability. Our borrower with the tax credit has a tax liability of $5,010 versus the borrower without the tax credit has a tax liability of $4,778. And I hear a lot of stuff out there that comes back to me that is incorrect. So the borrower can use, the borrower doesn't have, the fact that somebody gets a refund doesn't mean they can't use this tax credit. It's whether they could use, whether it would be beneficial to them or not depends on if they have tax liability. Not whether they get a refund, not anything else. If they have tax liability, and probably the majority of people, especially first-time homebuyers, are going to have tax liability. So, when you're doing your taxes, you determine, okay, here's how much I owe, how much did I pay, and if I paid more than I owe, I'm going to get a refund. If I paid less than I owe, I'm going to owe. So it really just depends on what the tax liability is. So as you see in this instance, the tax liability is $5,010 versus $4,778. But our borrower, who has a tax credit, gets to do a dollar-for-dollar reduction to their tax liability to determine the amount that they owe. In this case, $1,589 subtracted out of $5,010 means our borrower with a tax credit has a tax liability of $3,421, and our borrower without the tax credit still has the same tax liability of $4,778. They paid in federal income taxes, probably through their job, $5,730 in 2013. So when you subtract out the difference, our borrower with a tax credit gets a refund of $2,309 versus the borrower without it, it's $952. So as you can see, that is a huge benefit to anybody, but it's only available to a first-time home buyer. So they can take this credit for as long as they live in that property. They can take it for a full 30 years if they're going to live in that property for 30 years. If they refinance that first mortgage, and every time they refinance that first mortgage, they have 1 year to come back to us to ask us to reissue the certificate, and it will be reissued based on the original terms when they purchased the home. And it will be good for the original term. We had, I want to say about a year and a half ago maybe, we had a borrower come back to us and ask us to reissue his mortgage certificate because he had refinanced his first mortgage. And I want to say it was maybe, let's say it was June, and we went to look at his information, and his 30 years had been up in April of that same year. So he had used this mortgage credit for 30 years. We could not reissue it because he'd already used it for 30 years. So he used it for 30 years. And it's based, so as long as they're paying mortgage interest, they have tax liability, and they live in that property, they can use this tax credit for that long. I mean, unless the IRS comes and makes some kind of change, not that they wouldn't grandfather in somebody who already has it, but as it stands right now, they can use it for that period of time. You can also, as a lender, Fannie, Freddie, and FHA allow you to use that savings to qualify the borrower so you can add it to their income. VA says that you can use that towards their federal income tax to help with their residual. And USDA allows it to offset the PITI. It's kind of crazy to me, but they do. They allow it to offset the PITI to help the borrower qualify. So hopefully you can see that it is a huge, huge benefit to anyone, but it's only available to a first-time home buyer. But it's a great program, and we do thousands of these a year. And just to kind of add, borrowers are pretty savvy about this. Borrowers know about the MTC program. In January, our phones start ringing off the hook. Where's my cert? Where's my cert? Where's my cert? A lot of them we've already sent out, and they just didn't know we sent them. But there are many borrowers who never got the cert, who never were approved for it. We have to approve borrowers for this prior to closing. If they close and we haven't approved them for it, they're not getting it. We included in our closing package. So if you are doing any loan with us, with the exception of an MTC, there will be a form in the closing package that you have the option to use. We do not require it, but it basically says, Joe borrower, understands that I did not apply for and did not qualify for, was not approved for. I don't think it says you didn't qualify for. I think it says did not apply for or were approved for the MTC program. So I understand that I am not going to get it, and if I want it, I need to stop my closing. Lenders, the reason that we put that in our file is because lenders would have a conversation with the borrower and tell them that they were going to give it to them and apply for it for them, and then they never did. they forgot, and they either reserved it and never sent us a package and closed it, or they never reserved it at all, but the borrower didn't get it. So, in turn, they have sued the lender or threatened to, and lenders are paying for this benefit for the borrower. Either they settled on a lump sum, or they're somehow giving them something annually. And as you can see, that could be pretty expensive. So we put the form in there just to cover you as a lender if you want it, so that your borrower understands they're not getting it. Of course, if you're trying to do an MTC Basic and you never even reserve it, it's not going to be in there, so you don't have file. Or if you never reserve it, we also don't have file, and you don't have the form. But great program. So please use it if you can, and if you have any questions, let us know. Okay, so we're going to move on. We also do allow the home rehab, repair, and weatherization. I've said that we offer the standard and 203K FHA loan with our DPA. We call it Renovate Ohio, and that in and of itself is its own webinar. But if you're interested, certainly let us know, and we'll get you information. You do have to be approved with AmeriFirst, so you do have to have a signed contract with them. We do allow the 203B with repairs up to $5,000, and we allow the weatherization program up to $2,000. I know these references are the old references from the 4155, but nothing's changed on the requirements, so I didn't bother looking up what the new ones were, because they're not so easy to find. Okay, loan requirements. Borrower qualification, we ask you that you follow the program guidelines. Eligible properties are 1 to 4 unit, condos, PUDs. We are not currently offering manufactured homes, but we will eventually bring them back under Fannie's program. We just haven't honestly had the time to dig into the guidelines and all that, but we do anticipate bringing them back for Fannie programs. Income and purchase price limits are by county. You can find them on Lender Online or on our website, ohiohome.org. Our down payment assistance is a true second mortgage. And we do require homebuyer education on all products except for the MTC Basic, which again is your own first mortgage and not ours. So we don't require it, and we don't allow it through our program either. We don't allow you to take the borrower to take the home buyer education if they're just doing the MTC Basic with us. Okay, so credit score and DTI requirements. Conventional loans, credit score can be 640 with a DTI up to 50. VA and USDA, credit score 640 with a max DTI of 45. But if the credit score is 660 or higher, they can go to 50. If you're doing an FHA non-203K loan, credit score is 660, and the DTI max DTI is 45. If you're doing a 203K, you can go down to 640 on the credit score with a max DTI of 47%. We do offer on the FHA non-203K loans, we do allow a credit score between 650 and 659 for a 0.5% fee. That's really the only add-on fee that we have. We do allow manual underwriting for conventional VA and USDA loans, but not for FHA. And make sure that you're looking at our product guidelines for manual underwriting requirements if you're going to do a manual underwrite. Income calculations, we use eligibility income, not household income, so we're only looking at the income for those who will both live in the property and be obligated on the note. So you have a non-purchasing spouse who's going to live in the property, but they're not going to be obligated on the note, and you have to do both. Or you have somebody, a non-occupying co-borrower, who's going to be obligated on the note, but not going to live in the property. So they have to meet both of those requirements, that they're living in the property and they're going to be obligated on the note. If both of those apply, then we are going to consider their income. If both don't, we're not. We do ask for federal income tax, 3 years federal income tax required for all programs. We You may see us condition for income tax returns for a non-purchasing spouse, and that is only so we have evidence in our file that the non-purchasing spouse doesn't own the home or homes our borrower has lived in the last 3 years. We will accept alternative documentation if you don't want to get the non-purchasing spouse's tax returns. You can print off from the recorder's office or the auditor's office who has owned the home in the last 3 years. But you also need to remember that if you're going to do that, we need to know who the spouse is. We need some proof of the spouse's name. We find that an incredible amount of borrowers who are married and living with their spouses file head of household, which they shouldn't be. That's not a legitimate status if they're living with their spouse, but we're not the IRS, so we don't care. But when they do file head of household, they don't list who their spouse is on the tax returns, and normally that's the only way that we know who their spouse is. So if their spouse is not listed on the tax returns, then we're going to need some kind of evidence, maybe a marriage license, of who the spouse is, if you're going to go the alternate route of not providing us with tax returns. As I said before, we need at least 2 current pay stubs in the last 60 days or 1 recent pay stub and a written DOE. We need a copy of the borrower's degree if they're doing the Grants for Grads program. And then the HEROES program, again, look at our program guidelines for each occupation to determine what additional documentation we may need there to prove that they're eligible. I said that we require HBE on every loan except for, again, the MTC Basic. And it's pretty simple the way that it works. Probably 98% of the time anyway. So once the loan is reserved, if you can direct your borrower to our website, if they just go to ohiohome.org, scroll to the bottom of the page, there is an icon that says Homebuyer Education. They're going to click on that. They're going to log in with their last name and the last 4 digits of their social. They will complete a test and budget. They will also choose a homebuyer counselor, who is a HUD-approved homebuyer counselor. Once they've completed the test and budget, it will upload to Lender Online on the eDocs page, so you can see it, we can see it. The system will send an email to the counselor that they've chosen. That counselor has 48 hours to contact the borrower to schedule a 1-hour phone counseling session with them. I would say the majority of the time that works just fine, and we usually have the counselor, the certificate before we even get a package from you. But, not everything works perfectly all the time, so I do have somebody in my office whose sole job is to make sure that this HBE works like it should. And believe me, it is a full-time job. So if you have any issues with it, you can just contact us and we'll help you out. Okay, so fees associated with our financing. Everybody wants to know this. We allow you as a lender to charge up to a 1% origination fee. Up to you what you charge, or if you charge 1% or you charge less, we're just going to be looking at the CD post-closing to make sure you didn't charge more. Excuse me, U.S. Bank has a funding fee of $425. They also will collect, when they purchase a loan, an $80 tax service fee, which they do not want to show on the CD as payable to them. They really don't want the funding fee showing payable to them either. They'd much rather it show to you as the lender, because if for some reason they don't purchase the loan, that fee is coming to you as the lender and not to them. The tax service fee should be either paid to you as a lender or CoreLogic Tax Services. But they will collect it, so don't think that you have to get that the tax service fee is something that you need to be responsible for. They will collect it from you, and they'll take care of it. And there is a $100 admin fee owed to OHFA. Same thing if you're doing our MTC Plus. Same fees apply, except where there is an additional $250 loan fee payable to OHFA. And if you do the MTC Basic, it is just a flat $500 fee. And I hope you can see from the illustrations that those fees are definitely, the borrower is going to recoup those fees probably in year one. So you can charge any or all of those to the borrower. You are going to be charged them. You know, if you don't charge the origination fee, it's just money that you as the lender don't make because you keep that. The $425 and the $80, U.S. Bank are going to take that when they purchase the loan, and the $100 or the the MCC fees, we're going to require that we have them before we approve the loan to be purchased by U.S. Bank or before we send the borrower a cert for the MCC. And then there's also the Renovate Ohio fees that are out there too. So what happens after registration? You are going to process a loan. You're going to submit a commitment package to us, as we discussed. You're going to wait for us to approve it. Please do not close your loan without approval from us. Once we approve it, we will issue a commitment letter. We will also make commitment docs available, what we call a commitment package, available on the eDocs page, and you will be able to tell. We try to distinguish it by, it will start with an asterisk, and it will end with to be signed at closing. There are still other docs that you as a lender need to prepare that are on the PDF doc page, like the note mortgage, tax exempt rider, things like that, are things that you have to prepare. But you're going to close the loan, and you're going to advance the funds at closing. Post-closing, a package will be submitted to us and to the master servicer. Once both OHFA and the master servicer agree that all is good, the loan will be purchased by the master servicer, and you will be refunded all of those funds and get your lender comp and all that kind of thing. So we do ask that if you know a loan is not going to close, that you let us know so we can cancel it in our pipeline. And as I said before, same thing applies. We will always reach out to you before we cancel a reservation. We'll probably try to make a couple attempts to reach you, and if we get no response whatsoever, we will cancel the reservation, which if you have a live loan, you really don't want us to do, because if rates get worse, then you're probably going to be subject to the higher rate if we cancel it when it shouldn't have been. So what can change once the loan is reserved? We can change, we can make corrections to you key something incorrectly. We can make changes. It's not really necessary. We get a lot of requests to change purchase price and loan amounts and things like that for loans that haven't even been submitted to us yet. So you really don't need to. We will do that. We will make the changes for you, but you really don't need us to do that. Once you send the loan in and we review it, we'll make those changes then. And what can't change without our prior approval, you can't change the rate. You can't change the program. You can't cancel and re-reserve at a lower rate. So just make sure, again, that if you need to make changes to your program, that you contact us. Please don't cancel it and then think that you're going to, that you can re-reserve it some other way. Just contact us and we will help you out. We do have an awesome marketing department, so I kind of want to point that out. If we have marketing materials available on Lender Online, they're also available on our website. This is just a sample of what they look like, where you can fill in your own contact information if you want to take any of this stuff out. We will co-brand with you, so if you want your logo on there, you can contact our marketing department, and they'll work with your marketing department to get your logos on there and everything, but they do a really good job. Excuse me. And this is a list of our staff, everybody in our department. Any of us are happy to help you out. You can contact any of us, and we will, if we can't answer the question, we'll get you to the right person. I do want to put in a plug for John Dewey, who is our Real Estate Relations Manager. He offers free CE classes to realtors. He will come out if you want to schedule something with him for your realtors they get CE from it. I think he has 1 hour and 3 hour CE classes. So you just book him, you you invite the realtors, you bring the donuts or whatever, and find the place, and he will be there. He does a very good job. We get a lot of great feedback from him. We've been to his classes. He does a really great job, and he books up pretty quickly. So if you are interested in having him come out and do something for you, his information is here. John Dewey, Real Estate Relations Manager. So please contact him. Okay, so who should you call with questions? If you have questions on our program, you can contact anybody on that list I just showed you. If you have loan purchase or underwriting questions, here's the contacts for U.S. Bank and AmeriFirst. And changes in loan reservations, which you're all going to have at one point or another, can go to our lock desk, and that is their information. That's their email contact. And that concludes this webinar. Please feel free my contact information is on that slide. You're welcome to email me with questions or call me. And email tends to be easier for me because I'm in my email all day long, but if you call me, I will call you back. So as long as I'm in the office, you should get a response from me. And hopefully you learned a lot, and good luck with the program, using the program. And please, again, if you have any questions at all, feel free to contact us. Thank you.